And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week. Of course, it's Thursday. Britt asked me yesterday, when I tell you what day of the week it is, I tell you the day of the week so that when you watch these on rerun, you knew which day it was. Because I know you people are like, what day was the 15th? It's Tuesday. There you go. So, if you don't want me to tell you what day of the week is, I won't tell you anymore. So, I don't know about you, but I wake up a lot of morning and go, what day of the week is it, right? So, it's more of a check for me so I know where I am more than it is for you, but there you go. So, anyway, if you don't know what day of the week it is Thursday. So tomorrow is Friday, and the weekend is upon us already. This has been a very fast week, of course. Just really kind of coming back from vacation last week and getting back into the mix of things, following the hurricane and power outages and everything else that's been going on. By the way, it's been interesting, right? When you go overseas, you kind of get a look back at the United States. I had a very long conversation with several people. I'm bad about this. My wife hates it because when we travel, I start talking to people. But it's very interesting to get their perspective on the United States from their view about what's going on politically, economically, all these type of things. And but overwhelmingly, it's always interesting because you hear a lot of commentary here from the younger crowd, right? The millennials, the Gen Zs, talking about how America sucks. They want free health care, they want free college, and it's interesting from the perspective when you talk to people overseas, they all want to come here. And they're like, we like what happens in America. We like those opportunities and we want those opportunities. But it's a very interesting perspective. We kind of get trapped into our own bubble about what's going on politically, economically, whatever it is. And there's things we like, there's things we don't like. And, just as of late in particular, it seems that we've really gotten very divided. But, we always forget about how lucky we are as Americans, right? The opportunities we have, the ability to create wealth, the ability to take advantage of capitalism that people in other countries simply don't have. They don't have those opportunities. So, it's always important to kind of refocus back on things that are going on and then focus on the opportunities that we have and be grateful for those things. It's always the issue. My wife and I have this conversation quite often. We run through tough times like everybody does. We've had a couple of kids, in and out of doctors here recently and having to deal with some issues. And, it's easy to get kind of trapped up into this short-term cycle that, everything is bad, and how horrible it is and they're very tough. But it's always important to focus back on the fact that things could be a lot worse. And there are people that are dealing with things that are a lot worse than we have going on right now, both domestically and internationally as well. So just always try to be thankful for the things you have and be optimistic about outlooks for things going forward. It's easy to get into that very bearish mentality. Oh, things are terrible. It's the debt, it's the deficit, it's the dollar, it's this. And of course, there's plenty of YouTube channels out there that will feed that fear, right? And tell us about how horrible things are. And these are all going to turn out to be very terrible outcomes for you and for your children and all these type of things. The reality is that yes, there's no doubt that we've got issues with the debts and the deficits, but these are things that may not impact us for our lifetimes, at least in my lifetime and particularly your lifetime, unless you're very young. But again, we go back and look at Japan as a good example. They've been dealing with debts and deficits for 40 years, 50 years, right? They're still going. They're not great, mind you, they're not doing great, but they haven't imploded, right? The world didn't come to an end for Japan, which is about 1/3 of the size of the United States, economically speaking. So, it's important to, as we talked about a lot, when you're talking about markets and money and these type of things, is to not get so overly involved in these very negative outcomes. If you look at a bell curve of distributions, they're very, very low probability events, and that keeps us from making the right decisions with our money. Now, why am I telling you all this morning? Well, let's talk a little bit about the market, right? So here's what you need to know before the bell. Very interesting over the last couple of days, we've had this rotation we've talked about here on the show, and I'm sure Mike and I will discuss it a bit this morning, is this rotation from large cap to small cap. And it's been astronomical. It's been one of the largest rotations that we have seen on such a short time frame, over 5 days, that we've really seen at any point in history. Russell 2000 example is 4.4 standard deviations, away from their moving averages. I mean, that's just an incredible move, extremely overbought very quickly, right? And of course, headlines are now coming out like, oh, is this the end of the AI bubble? Is this the end of the AI chase? Is this the beginning of the great crash? All these types of narratives, right? Just, we've had a rotation in the market. It's nothing more than that. And more importantly, let's take a look at the market, right? So this is the S&P going back to just the beginning of this year. It has been just a nonstop grind higher. And here's the sell-off, right? I mean, it barely shows up on the chart itself. And if we back this up just a bit, let's just go look at a 2-year time frame for the market. You can barely even see this sell-off. The markets needed a healthy rotation. And Mike and I have been talking about this for a while, is that the markets needed a rotation. The good news about this rotation is that it's broadened the breadth of the overall market rally. So the breadth of the market rally has now expanded. That's good, right? That's bullishly positive for the markets. That broadening of the market now gives this fuel for the market in general to keep rising higher. Even if tech begins to slow down its advance, right? The rest of the market can now continue to lift the S&P higher, because now we've got other sectors of the markets now engaged in that move within the markets, right? So, this is why, again, lots of headlines like, oh, this is the beginning of the crash, you better get out of the markets. Be careful with that, because that's not exactly what it means. And more importantly, this correction is needed, right? In order for a market to continue to go higher over time, you've got to have corrections from time to time. And if we just look back at the market over the last couple of years, you see these regular corrections all along the way, right? Some were bigger, some were smaller, but we continually kept correcting back to moving averages over time, which allowed the market to continue to advance. Markets cannot just go straight up. They have to go up. They have to pull back. They have to reset buyers and sellers, and that allows the markets to go higher once again. So it's important to just keep involved in the narrative, right? The narrative is doom and gloom and everything's coming to an end. And maybe that's the case. Maybe this is the potential beginning of the big rotation that leads to a bigger sell-off in the markets. We're moving into the right time of the year for that, August, September, October. We've talked about that 5 to 10% correction. Maybe this is the beginning of that 5 to 10% correction. We don't know yet, but these are the things to pay attention to, but don't go all the way out there on the end of the curve to where some of these comments are being made, because the AI chase isn't likely over, right? The earnings growth for the S&P 500 is coming from those top 10 companies more than they are from the bottom 490. And earnings are ultimately what drives the market. So again, just keep focused on what's happening when the markets itself and manage your portfolio that way, rather than letting these big emotional narratives drive you into psychologically bad investing decisions. If the market begins to break down, we'll know, we'll let you know, and we'll all be good. But that's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Lebowitz. Got a lot of stuff to get into. We haven't talked in about 2 weeks, so got a lot of stuff to cover this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Actively help you reach your financial goals with RIA Advice.
Welcome to the show this morning. This is the worst coffee on the planet. I'm filing a class action lawsuit against my firm for buying this coffee. It's absolutely terrible. But I was desperate this morning. Didn't sleep well last night. Had too much going on. Woke up at about 2:30 this morning. So well, we're gonna be a little cranky this morning. Larry, you're on my nerves already in our chat. So yep. Is that better? Perfect. So why'd you turn it on? Why did you turn my audio on?
No, it was the YouTube audio on your computer.
Yeah, but it wasn't on yesterday, so you must have turned it on.
Not.
I'm blaming you for it.
Okay.
You're in the class action lawsuit with the coffee man. I think you bought this coffee, too.
I offered you some Death Wish coffee.
I don't want to die this early in the morning. There needs to be a nice balance between coffee brands, okay? Can't have complete crap and Death Wish. There's got to be something in the middle.
Black Rifle.
There you go. All right. We don't have any here, do we?
No.
Let's see. There you go. A lot of help you are this morning.
I'd get you some over the weekend.
Okay, thank you. All right. Welcome to the show this morning. A lot of stuff to get into. Mike and I have been swapping vacations as of late, so he hasn't been here on the show. I haven't been here on the show. So anyway, we've got a lot of stuff to catch up on. Mike, welcome to the show this morning. How are you?
Thank you. It's been a minute.
Yeah, it has. So yeah, a lot of stuff to catch up on. We can start with a little bit about the Federal Reserve, I guess, as always. It's interesting right now. If you take a look at and I just pulled the chart yesterday, so it may have changed this morning some, but from the CME, looking at the odds of a September rate cut, which is now above 90%. I think it was like 91.7%. So, the market is really starting to move towards this idea the Fed is going to cut rates in September, but there is some potential here that we maybe see them cut rates in July. That's just next week potentially, but maybe that's too soon. We'll see. But again, if they didn't want to, and Goldman Sachs kind of made this comment that if they don't want to be seen influencing the election, a July rate cut would be better than September.
Yeah, a lot's changed over the last few weeks regarding what the market expects, what the Fed has been saying. And if you just put me in a dark room and all I could see were the economic data and Fed speeches, and I didn't look at what the odds are, I would say I would put the odds at 50-50 of a rate cut at the, I think it's July 31st meeting. But if you look at futures and if you look at other things, the odds are still pretty small, albeit very high odds for a cut at the following meeting. So what's changed? We've had continued degradation in the labor market. Nothing significant. In particular, the unemployment rate is now 4.2%, and it's been rising. Typically, the unemployment rate is either going down, sometimes it's stable for a little while, or it's going up. And it doesn't really zigzag that often. So when it gets into a trend, it tends to stay in a trend. So, that's one thing. And like we've talked about quite a few times, if you look at the data underneath the headline data, the labor market is not doing well, is not doing nearly as good as the headline numbers say. And Powell has said as much. He said, look, we look at all this data. We have all these PhD economists. We have a better feel for what's going on in the economy than the labor reports. Same thing with CPI. He's talked about shelter numerous times over the last couple of months, how it's a lagging indicator, but it's 40% of the inflation number. And when it catches up with what we know to be fact already, CPI will come down. So that's, I think what he's trying to tell us is that labor and inflation, which are their two goals, their two objectives, have kind of come back into range. Then you just look at all the various speeches they've given. They're talking about that they're getting comfortable with cutting rates. Barkin said that it's no longer needed, that we no longer need to say that inflation is elevated anymore. I thought that was a big statement.
Yeah.
She's basically saying that inflation is back in the range of normality. So, so you kind of think about this, you look at the data, and the what really gets me is that Fed funds are 5.25 to 5.5, and we're not that far from a normal, by normal I mean pre-pandemic economy. There are certainly gauges that are well within the range of pre-pandemic, and others, inflation is still a little high, that are just slightly above. And I think what they're really scared of is that they leave rates up too high for too long. And so they're itching to cut rates. But like you said, Lance, you have an election. Trump has already said that if Powell does the wrong thing, he's going to be fired. So, Powell's not going to listen to him. But they are conscious that there is an election, and they don't want to be seen. They don't want the public to think that they've swayed an election. So a July cut makes more sense, but I really do think the first cut will be September, kind of based on what the market's saying. And the way, if the Fed wanted to cut in July, I think they would be a little more aggressive in their speech, so it wasn't a surprise.
Well, or maybe they do want to surprise. I mean, we've seen them do this before in the past, where they cut intra-meeting, or they hiked intra-meeting to actually surprise the market. I mean, you never know for sure, but if you look at the CME odds of a July rate cut, they're fairly low right now. So really, it looks like the bets, at least from the market. And so the Fed does listen to the market, so the market's really kind of giving them a green light for hiking, for cutting rates in September. So, I agree with you. I think it's probably September. We'll see what happens. But, there's clear evidence, if you look at temp hiring, that continues to decline. That's, previously been, and again, we talk about these recession indicators, right? The inverted yield curve. We talk about, the leading economic index, 6-month rate of change, the unemployment rate rising above certain levels, jobless claims above certain levels. These have all been great indicators for when the economy is moving into a recession. Well, the reduction of temp hiring is also one of those. It's when you start seeing a big reduction in temp work, that's where companies are really, that's the first place that companies will cut back, right? So, if I'm a corporate employer, I've got full-time employees and I may hire temp work to fill in some gaps. Well, that's temporary work, so that's very easy to get rid of. So if I'm looking to cut my overhead expenses, temp work goes first, then I get into the layoffs, right? And so it's kind of that progression. Well, we're seeing that progression starting. We are seeing layoffs. We are starting to see pressure in the credit markets. We're seeing delinquencies rise. We're certainly seeing pressure on the consumer, which is going to translate into earnings growth. So as companies come under pressure, they start this process. But, so I think the Jerome Powell made this statement is like, we don't want to wait too long. There's some pretty decent evidence here, Mike, that the economy's slowing down a lot more than it may look like on the headline numbers. That retail sales number we saw earlier this week that came in flat, that sounded great, except you had this huge seasonal adjustment. The non-seasonally adjusted data was down almost 5% for the month, which was a fairly substantial drop in retail sales. So I think we're definitely seeing that sign of a slowdown. And if the Fed waits too long, they run that risk of having to cut too aggressively to try to play catch up.
Right. And remember, retail sales isn't real, so it doesn't account for inflation. So if retail sales grew at 0%, if you factor in inflation, it really shrunk at, whatever the rate of inflation is called, 2.5%.
Sure.
So just from that respect, it's worse. But again, the seasonal adjustment was crazy. So if you take out that seasonal adjustment, it was a really bad number. And again, retail sales for the last few months has been bad. And it's not, look, we could say, well, the government data is garbage. Well, not every, but many retailers are telling us the same thing. Their sales are slowing. Look how many companies are reducing prices and making that public. We've seen probably half a dozen key retailers say in some form they're reducing prices because their customers are getting more picky. They're shopping around more than they used to. So something's definitely changed. Again, it doesn't mean we're going into a recession or a depression. It means that we're back to a pre-pandemic economy. And again, rates were never 5% during, at any point in the last 15 years. So I think the Fed recognizes that even if we're just going to a normal economy, they have to get rates down at least 2%. You can make a case for 3%. And I think they want to start that before it's too late to start it. Try to get ahead of the ball here.
Yeah, and look, and you made a very good comment here about the government data being garbage. That's a really important point. And from an investing standpoint, it's very, very critical. The problem for a lot of us that are managing our own money, doing those type of things, is that we're looking at what's really happening to us. And so our view is that things are really bad. So we start making investment decisions based on that. We may not agree with the government data, but that's what the market looks at. And the market is going to respond to the government data. Whether you agree with that data or not is irrelevant. What the market's going to look at is CPI. What is CPI doing? What is PPI doing? What is employment doing? That's what the market looks at. Just because you don't agree with it, that doesn't matter. That's what the markets are going to trade off of. So it's, as we talked about earlier, be sure and separate out a lot of these narratives. And we'll talk a little bit more about this on the other side of break, because I want to talk about this recent spike in small cap stocks and what that means with Mike. But again, be sure and separate out the narratives for what the market pays attention to, because those can often be two very, very different things. All right, quick break. We'll be right back with Michael Lebowitz. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult.
There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Today is a very sad day because we had a very serious set of deaths in our house.
The Real Investment Show podcast.
It's been just a very traumatic few days. We lost our new coffee maker, we lost our air fryer, and we lost our oven. When this power surge came through the house,
same show, your schedule.
That's how big the surge was coming through the house, but I've not had coffee for 2 days, so just beware. I don't know what you're going to get this morning on the show, but
at realinvestmentadvice.com.
I'm a little cranky.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So as I was talking about just before the break, it's important to keep separated our personal views and how we see things versus that of the market itself and what the market looks at. And, if you're listening to some guy on YouTube talk about, this is what I see in the data and this is how this is all going to turn out and it's all going to be terrible, whatever it is, be real careful with that. Because markets can remain bullish a whole lot longer than you can expect them to because of momentum, because of everything else that's going on. And again, what the markets pay attention to is the official government data. So again, we can break down the employment data and say, oh, this is terrible data. It's all going to mean this, and this is ultimately going to happen. And maybe it will, right? But it could take a much longer time to get there than what you would expect. And again, a good example of this was in 2022. Everybody expected a recession and didn't happen, right? All the data suggested we were going to have a recession. Still does. We still have, as I said, temp hiring and inverted yield curves and all these other type of things suggest that we're going to have a recession at some point. We will at some point have a recession. But how much money did you lose by not being invested because of emotionally driven headlines and YouTube channels and all these other type of things that kept you out of the market because they were predicting doom and gloom? That's, and so again, we got to take our personal biases out of this and then look at the data. And this is, look, trust me, Mike and I are inherently bearish, right? It's in our nature. It's in our blood. We're conservative. We're bearish on our outlooks almost all the time. It is a challenge for us to be bullish on the markets. But we understand that we have to separate out our bullish, our bearishness, our personal bearishness, for what the market's doing, and looking at that overall economic data. Mike, I'm putting words in your mouth, but agree, disagree, go ahead.
Yeah, I mean, the trajectory of, economic growth, macroeconomics, the amount of debt will leave your head spinning and can turn, will send you to your den to hibernate. But that's not what drives markets. What drives markets is liquidity and sentiment. And that's what's been driving the market. And, like this whole AI chase, right? It looks very similar to what we saw in the late 90s with the World Wide Web, the internet, technology at the time, right? So we can say it's not going to be like, it's not going to be a big deal, or we could say it's going to be a huge deal. And it doesn't matter what we think about AI. It's what the market thinks at the moment of AI. And it thinks it's going to be the greatest thing since sliced bread until the last couple of days. So the question we have to ask ourselves is sentiment changing? Is it switching? Is there a realization that AI may not be all it's cracked up to be, that the profits from AI may not be as great as they were saying, literally a month ago? And that's the market. The markets are very reflexive. They feed on themselves. So when you're in an uptrend, everyone's buying into those same narratives that are driving the trend, regardless of whether those narratives are true or false. And a lot of times they're false, or they just don't prove out to be, necessarily as true as many projections. And the same works on the downside. When the market starts selling off, people get scared and they sell more. So it's our job to figure out if what we're seeing today is just a natural adjustment to the market, which is very healthy, right? We've talked about this bad breath ad nauseum for the last, 2 months, month, or whatever
Exactly.
It's been. And it's correcting, but it's correcting in a way that most people didn't expect it to correct. Mm-hmm. Some stocks are doing very well. The largest stocks are doing very poorly. Just a month ago, it seemed like those Magnificent Seven stocks, NVIDIA, Apple, Amazon, all of those could never go down. Well, of course they can go down. But the flip side is that some stocks aren't always going to go down. They're going to go up. So we've seen that adjustment. You have a lot of hedge funds that have very leveraged positions. And in this case, they were short, small cap value, that type of stuff, and long AI technology, some of the communications companies. And that trade worked out poorly for them, but because they're leveraged so much, they have to sell. The market forces them to sell, and that's some of the reflexivity in the market where a move can beget a bigger move. Mm-hmm. So that's what we're trying to do. We actually took a couple chips off the table, not very big chips, but a couple chips off the table 2 days ago, in anticipation that the market was starting to get a little way ahead of itself, a little offsides. And, we'll see if what we've seen again is going to last a week, a few days, or if this is a real rotation. But we don't know.
Yeah, and that's an important part because we've seen these rotations before. We saw them numerous times back in 21, 22. We saw these rotations between small cap, mid cap, and large cap, and they've all been temporary. And then the money movement has gone back into large caps, and primarily because that's where earnings growth is coming from. And if we take a look at where earnings expectations are, where earnings growth comes from, it's coming from those largest cap companies. Right. And it's interesting right now, Mike, because I ran some analysis yesterday. So for the weekend's newsletter, I'm writing a little bit about what's happening with this, this small cap chase, and is it sustainable? But what's interesting is that the headlines over the last few days has been, well, the drop in yields, it's what's driving the rise in these small and mid cap stocks. But what's interesting about that is that the last time that yields dropped last year, small caps fell with yields. So we have this it was kind of interesting. You've got these two periods where yields fell and small caps did exactly the opposite each time. So I ran back and looked at the 6-month rate of change going back to 2000, the 6-month rate of change in yields versus the 6-month rate of change in small cap stocks. And what you find out is that when yields fall, it's not good for small and mid cap stocks. Why? Well, they're very dependent on economic growth. If yields are falling, it's a function of slower economic activity, which is why yields are falling, inflation is declining, which is not good for the balance sheets and earnings of these small and mid-cap companies. So we'll see if this time is different, but historically it suggests that this current rally may not be sustainable in an environment where earnings growth is slowing.
And here's the other thing, and you caught me on this the other day. And, I think we catch each other from time to time making the same mistake that most people make. Mm-hmm. This is happening because of some news event. In this case, Trump, right? Trump got shot. He's now, the odds of him winning the election are even better. That's why we're seeing what we're seeing. And this isn't about Trump winning or losing. This isn't about J.D. Vance being his vice president, what that may mean for corporations. This is markets. This is a lot of liquidity and a lot of investors chasing the same stocks. And at some point, there had to be a scare, a concern, because a lot of people, both retail and institution, were very uncomfortable with what was going on. And once they saw a little chink in the armor, they were going to sell. And that's what we saw.
Yeah.
Can you blame it on Trump? You can do whatever you want, but that's not what's driving it. And it's not, not necessarily because the Fed is going to cut rates either, because we've been talking about the Fed cutting rates for 2 years. And if you go back in history, when the Fed cuts rates, it's not good for stocks. So, there's a lot of narratives flying around, I think in large part because of the election. So just be careful to appreciate them and understand them, but realize that the market is its own animal and will do what it wants to do. My last article was on irrational exuberance, a term by Greenspan. and
no, wait, don't go too far into that, because we're going to talk about that next segment where you got plenty of time. Gotcha. But go ahead and make your point, and then save the punchline.
No, the point is markets can become more irrational. They can feed off narratives, and they do all the time. There's always a narrative for what a market is doing, not just stocks, but bonds, gold, corn, wheat, cocoa, whatever it is. Trading, baseball trading cards. There's always a narrative as to why they're going up or down. And that is what's kind of driving the day-to-day investment. There are big macro themes that do steer things, but those are much longer term steerers, if that's a word, of the markets. So don't get caught into these narratives. Where there are going to be new narratives now popping up to help explain why NVIDIA is down and these little small companies are up, why value companies are doing better, why Pepsi was up 3% yesterday. Here's a great example. Intel was up 4 or 5% yesterday. Just about every other chip company was down 5, 6, 10% yesterday. Mm-hmm. That has nothing to do with Intel. That's been the trade du jour for the last 6 months, where they sell Intel and they buy basically every other chip company.
Yeah, I think that's a hugely key point to all this, is that this was massive short covering, to your point, in these hedge fund trades. And again, that's going to be the one thing we have to kind of figure out over the next few days, is that sustainable and for how long? Quick break. We're going to come back with Michael Lebowitz, talk about irrational exuberance. His new article is out on the website. We posted it yesterday. It's on the website now for you, realinvestmentadvice.com. But we'll come back. We'll talk about irrational exuberance then and now, and is there a difference? Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Mike, as I noted, Michael wrote an article yesterday. It's on the website, realinvestmentadvice.com. And talking about irrational exuberance, which was a term that was coined by Alan Greenspan back in the late 90s, talking about the markets. And this was as we were heading into the dot-com bubble and well before we got to the peak. I believe, correct me if I'm wrong, Mike, but I believe he uttered those words around 1995, 1996-ish, somewhere in there. And the market just kept going for like 4 more years before the dot-com bubble, kind of ever blew up. But irrational exuberance has been bantered around, the markets for a long time. Every time the market goes up, it's like, oh, it's irrational exuberance. But there are some key differences, as well as similarities between the current market and what we saw, back in 1999, 2000. So without stealing any thunder from Mike, tell me about your article.
So what I wanted to do was kind of get inside Greenspan's head and appreciate why he was saying what he was saying. And you're right, in December 1996, he used the word irrational exuberance to try to describe the stock market. And look, at the time, he was very concerned that Japan's bubble had just popped 7-8 years earlier, and they were going through and for the next 20 plus years after, continue to go through just a massive economic upheaval because they let stock prices, real estate prices go way too high. So he kind of questioned out loud whether the U.S. stock market was doing the same thing. And what's interesting is, we had a recession in 1990, 91. Since then, stocks were up at this point in time when he mentions those words, the S&P was up 250%. And just over the last 2 years prior to his speech, they were up 60%. So if you look at a graph that just stops at December 1996, you see something that looks like a massive bubble. Mm-hmm. And it looks very similar to the market looks today. It's just shooting higher. At the time, the CAPE valuation, which is a good measure of valuations, was above where it was during the Nifty 50 bubble, which was, I guess you could say, the last big bubble, and not far off from where we were in 1929, and higher than. So it was the second highest CAPE we'd ever seen, again, just not that far behind the Great Depression. And other valuation measures told you the same thing, that valuations were basically, other than the Great Depression, the highest they'd ever been. So Greenspan had ample reason to worry and to try to, I think, to some degree, try to steer the market back down so that you didn't have what Japan had. But of course, like you said, Lance, what happened was for the next 3 years, 97, 98, 99, the market took off like a rocket ship. It didn't care that valuations were out of control. And the narrative at the time was the internet, technology, everything was booming back then. The internet was going to change the world. And it has. Look, it has changed the world. But along with
maybe
it
not for the
changing
better.
well, for the better and for the worse, right?
Right.
There's a lot of great things about it. Like, I don't have to work with you in Houston. I can be here on the East Coast.
That is a bonus, yes.
The bonus for both of us, probably. Right. So, but the projection was that GDP would rise, that earnings would do better, and everything would be grand. And, like I said, stock prices and valuations rose sharply. And, when you look at that graph, 1996, it's just halfway up this ladder that just, keeps surging. Ultimately, valuations got well above where they were during the Depression. And as we know, everything came crashing down in 2000 to 2003. And, I guess you could say his exuberance call was right, but it was way too early. Mm-hmm. And that's, it kind of mirrors today a little bit that we have this narrative, the AI narrative, that because of AI, our economic growth trajectory, which has been lower for the last 30, 40 years, is going to start trending upward, that companies are going to make more money, that NVIDIA is going to keep selling massive amount of GPU chips and have a monopoly on the market. There's a million narratives. And look, we don't know if those narratives come true or not, but quite often they don't come true. They help explain what a market is doing. They don't really, it's not really the guiding, really what's going to happen. If you go back and look at earnings growth since 2000, the economy has grown about 1% less on average than it did prior to the dot-com bubble. Earnings, very similar, corporate earnings or corporate profits, very similar results. So, the internet came, we have it. It's in some cases very productive, in some cases very unproductive, but it actually detracted. It didn't detract. It detracted some from economic growth, but all the trends from prior were still weighing on the economy and continue to weigh on the economy. Productivity, demographics, and more, since then, the debt bubble that we're in. So, take everything with a grain of salt, but realize that irrational exuberance can become even more irrational exuberance and last for years. Mm-hmm. And there's no timeline on markets on a set price or a set valuation measure that says that's it. It can't go any higher, because markets, again, will do what markets want to do until you hit this point of instability, and it just can't sustain itself anymore.
And real quick there, I want to touch on something because we're about to run out of time. But one thing that we've talked about before, and the one thing that we've mentioned numerous times, is the importance of credit spreads. And this really relates exactly to what you're saying, is that markets can remain irrational for much longer than you would expect them to do, right? I mean, and even John Maynard Keynes said markets can remain irrational longer than you can remain solvent. And the kind of the telling point of every peak in the bubble going back over time, no matter what looks at, there's always a crisis moment. There's something that happens where sellers stand up and go, yeah, I'm out. And they're all out at one time. And that's how these crashes occur. And credit spreads have been a really, really good indicator of those moments, of whether it's a 20% correction like in 2018 or whether it's a bigger correction like 2008. Credit spreads have been a good leading indicator of that concern because the credit markets are so large, they're so dependent on everything, and they're based on fundamentals. And one thing we're seeing right now, for the first time, we haven't seen this in a while, but we're starting to see credit spreads begin to pick up. You look at triple C's versus B's, starting to see that first initial sign. Now, it's way early. It doesn't mean anything right now, but we are starting to see a little bit of stress in the credit markets, which is at least a warning that we need to be paying attention to.
So, yeah, and here's another good point. I recently read a piece by Ben Hunt, and it was really interesting. And I forgot what he calls this principle, but bottom line is we all knew that Joe Biden was impaired. We can debate all day how impaired he is, but some people think he's very impaired. Some people don't think he's that impaired, right? He went on a debate stage, and it became obvious to everyone that he is decently impaired. And what Ben Hunt's point was that even though most of us knew there was some level of impairment, when the media started talking about it, especially the liberal media, when the Washington Post and the New York Times brought it up, when senators and representatives on the Democratic side brought it up, it became a known. It's not that you knew it, but now everyone knows it. And that changes everything. And as you see, he's fighting for his political life right now. The same is true for the stock market. Everyone knows that what's going on is to some degree irrational, right? Stocks just don't go straight up because they have AI in their name or because they use the letters AI 52 times in an earnings report. But until everyone knows that everyone knows it's irrational, it'll keep going up. And that's what makes our jobs really hard. When do these bubbles correct themselves? When do people kind of realize in mass that things just aren't where they should be? And again, what does that mean? Does that mean the market will go down? Maybe, but it also may mean that, like in 2000, people will flock to small caps, and they did just fine. So, this is a really tricky environment. We could stay irrational for 2 more years. We could have a massive rotation that lasts for a while, where small caps, value, higher dividend stocks do very well, and some of those leaders of the last couple of years fall by the wayside. Or the market as a whole could go down, both large and small caps. So, the key is to kind of look at the market, look at the technicals, look at a lot of those indicators, and be very careful of any narrative, whether it's a boom or a bust narrative. What people are telling you is, in large part, is what they're selling. So, just be very mindful and read the other side. Read what people that think that the economies do well because of AI, read what they have to say. Maybe there is some logic to it.
We'll see. I've got my doubts that AI is going to be as productive as everybody thinks it will be, but we'll see. I could be wrong. Hey,
right.
Mike, thanks a lot, buddy. All right, that wraps up the show for the day. Be sure to get by the website, realinvestmentadvice.com. Also, please like and subscribe to the channel. We certainly appreciate this very much. We appreciate you joining the show every morning. But again, like and subscribe certainly helps us out a bit. Also, get by the website, realinvestmentadvice.com. Mike's latest article out on the website right now. Subscribe to our weekly newsletter. It's absolutely free, along with our daily market commentary to help you manage your portfolio better. It's all there for you for free to help you out to be a better investor if you're trying to do it yourself. We're trying to help you, right? So take advantage of it. Anyway, realinvestmentadvice.com. Have a great day. Tomorrow, Richard and Danny be back here for Financial Fitness Friday. Have a great weekend.